So here we have this question called Grange, and we're looking at pretty complicated issues in relation to the group. So the first thing to do is to go to working number 1 and to determine our group structure. So we've got Grange, which is our parent company, and it's got an investment in Park. It did own 60%, but it then bought a further 20%. So this is a step-up acquisition. It's got an investment in Fence, and it did own 100%, but it sold 25%. So this is a disposal where we keep control. So we're going to keep consolidating Fence. And if we inspect the question, we also have another investment called Sitin, and we did have 100% of Sitin, but we sold 60%. So Sitin became an associate, and that sale was on the last day of the year. And again, in terms of our disposal of Fence, that sale was on the last day of the year. So we don't have to split the NCI. That he's taken out one layer of complexity for us, but don't worry, he has left in plenty of layers of complexity to keep us challenged. So what I'm now going to do, I'm going to work my way through the question line by line. So the first thing that we have is PPE, and all I'm going to do is I'm going to add together all of the assets of the group companies, being Grange, Fence and Park, because we've got control over those. I'm not going to consolidate Sitin, and the reason why I'm not going to consolidate Sitin is because it is an associate at the end of the year. If you take a look at the requirements, the first thing the examiner asks us to do is to work out the gain on disposal of Sitin. I'm actually just going to embed that in the question overall. I mean, you can do it separately, but I think the question lends itself to a line-by-line approach. Next, we've got the investment in Park. So what are we going to do with that investment in Park? Well, all I'm going to do at this particular stage is to go to my goodwill calculation, investment in subsidiaries, per the SFP. We've got cost figures of 340 for Park and 134 for Fence. We've then got our investment in Sitin. Well, we've established that Sitin is an associate, so I'm going to open up working number 6. I've got working number 4 there. I should have a working number 5 for reserves. And a working number 6 for the associate. Cost in Sitin per the group SFP 16. Next, we've got our current assets. Add those together. $920. Share capital, 430 for the parent, and we've got share capital for our 2 subsidiary companies. So net assets working, share capital at the SFP acquisition, SFP acquisition. And as far as Sitin is concerned, I'd probably also stick in some figures. I might not end up using them, but just get into the habit of your old favourites. So in terms of share capital, 230 for Park and 150 for Fence. We then have retained earnings and OCE. So whilst we're dealing with these companies, we've got retained earnings of Park at the SFP date 170 and OCE of 14, and for Fence it's 65 and 17. We've then got the figures for the parent. The figures for the parent always go into our group reserves note, which is working number 5. Retained earnings, OCE for the parent, 410 and 22. So that gives us our total equity totals. We've then got our non-current liabilities. I'm going to add those together for our 3 group companies, which gives us a figure of 334. Trade payables, 354, and provisions of 20. So I've taken all of the data from the group SFP and slotted it into our answer sheet. We've then got some extra information. On the 1st of June X8, Grange acquired 60% of Park for 250 million. So this is the date at which we achieved control. Let's just pop down. And do you see we've got a problem? In my note here, I've stuck that in at 340. But the reason for that is if you read through the rest of the note 1, you'll find that we've bought some shares later. So all I'm going to do, don't use liquid paper in the exam, just replace it with the correct figure. So it should be 250 at the date we achieve control. Excluding the franchise referred to below, the fair value of the net assets was 360 million. Do you see that the examiner is developing a habit? He's developing a routine. He's always telling us the fair value. The excess of the fair value of the net assets is due to an increase in the value of land. Okay, that was the 1st of June. Park held a franchise which at the acquisition date had a fair value of 10 million. This had been not recognised in the financial statements of Park. So what I'm going to do here is I'm going to add in that franchise at a value of 10 million. The franchise had a remaining life of 5 years to run at that date and is not renewable. Our year end is the 30th of November X9. So therefore we need to amortize the value of the franchise. So it's got how long left? It's got 5 years remaining. Let's work out that. June, July, August, September, October, November, 6 months plus a year. So what we're going to do is we're going to say it has got 3.5 years remaining out of the 5-year lifespan times 10. So that means the franchise has a value of 7 million at the SFP date. So that means we've got an intangible asset. So I'm going to go up here. I've got intangible assets, franchise from working number 2, and I'm putting that in at a value of 7 million. Grange wishes to use the full value method for goodwill. The fair value of the NCI at acquisition was 150 million. So I'm now going to go to my goodwill calculation for Park. We've got the cost. NCI at acquisition, 150 million. That also goes into our goodwill calculation for Park. At acquisition, 150 million. For every debit, there must be a credit. Yep. That's right. You've got a choice with the franchise. I could put it in at a figure of 10. And then I could say I'm going to amortize the franchise 1.5 years out of 5 of the value of 10. So I could amortize it by 3 and I'll still get the figure of 7. So there's two ways you can do it. So we're using the full value method for our acquisitions. We are told that the retained earnings of Park were 115 million. So I'm going to put 115 million to working number 2. And OCE was 10 million at the date of acquisition. So if I now add that up, 230 plus 115 plus 10, that gives me a figure of 355 million, which is the book value or the carrying amount. So our fair value adjustment, which is the balancing figure, works out as 5 million. And it says in the question, in the first paragraph in note 1, the excess of the fair value of the net assets is due to an increase in the value of non-depreciable land. So that gives us a figure of 5 million like so. So I'm going to go up to PPE plus 5. That comes from working number 2. What have we done? We've credited equity with the fair value adjustments, and I'm going to debit PPE. At the bottom of note 1, it says Grange acquired a further 20% interest in Park on the 30th of November X9 for a cash consideration of 90 million. So here we've got an increase in an investment. So we've got our increase in investment in Park, and all I'm going to do is I'm going to go credit cash 90 million. I know that the other entries are debit the NCI and debit or credit reserves, and we'll come back to that later. Note 2. On the 31st of July 20X8, Grange acquired 100% of Fence for 214 million. Holy moly, I cry. The examiner is giving me a hard time today. So I'm now going to reverse. So we did have a figure of 134 in the balance sheet. I'm simply going to change that to 214. Sometimes you have to accept that he will give you a bit of a raw deal in relation to the numbers. The identifiable net assets of Fence had a provisional, okay, there's a clue in the word, that figure's probably not finished yet, a provisional fair value of 202 million. So I slot in that figure of 202. At the time of the business combination, Fence had a contingent liability with a fair value of 30 million, and that's included in the figure of 202. At the 30th of November X9, the contingent liability met the recognition criteria of IAS 37, and the revised estimate of this liability was 25 million. So what we now have to do is to put through an adjustment. So we've got our contingent liability. It's met the recognition criteria, and what we need to do is to put in a liability of 25 million into our net assets. If I'm going to put that into my net assets, I also have to put that into my liabilities in the statement of financial positions. That's going to go into the provisions. It's satisfied the recognition criteria, so we're going to increase liabilities by 25 million. The accountant of Fence is yet to account for this revised liability. So they've not put that through the accounts, so we have to put that through the accounts. So that's in respect of Fence. Grange had not completed the valuation of PPE of Fence at the 31st of July X8, and it was not completed at the year end, but the value was received on the 30th of June X9. That's within the 12-month period, and the excess of the fair value over the book value was measured at 4 million. So what we're going to do here is we go back down to our working, fair value, PPE adjustment. I'm going to increase the net assets of Fence by 4 million, and also at the SFP date. It says the asset had a useful life of 10 years at the 31st of July X8, so I'm now going to charge depreciation on that fair value, and this is a bit of an unpleasant one. The asset, we're going to increase its value by 4 million, so I need to increase the value by 4 million up here. That's from working number 2, that's our fair value adjustment. We then got to work out depreciation. It's July X8 to November X9, so that's going to be 16 months worth depreciation spread over a 10-year period. Well, 10 years is 120 months. I'm going to work to the nearest 1 decimal place. So I'm going to reduce the value of the net assets by 0.5. Strictly, it should be 0.53333333. If you want to do it to 2 decimal places, by all means do it. Minus 0.5, working number 2, that's the depreciation, that's the PPE. So that's note 2 dealt with, but no, it's not. We've still got some more in note 2. The retained earnings of Fence were 73 million. Well, retained earnings form part of net assets. So retained earnings at acquisition was 73 million, and other components of equity were 9 million before any adjustment for the contingent liability. On the 30th of November X9, Grange disposed of 25% of its equity interest in Fence to the NCI for consideration of 80 million. So what I'm going to have to do here is to have a little note disposal of Fence. What have we done? We've sold those items for 80 million. And it says the disposal proceeds have been credited to the cost of the investment. That's why the cost of the investment is incorrect by 80 million. So here we're going to debit cash, and we know that the remainder of our adjustment is credit NCI. And it's going to be credit or debit reserves, and we'll sort the remainder out later. Note 3, on the 30th of June X8, Grange acquired 100% of Sitin for 39 million. So we go to our goodwill calculation for Sitin, cost 39 million. There will be no NCI because we own 100%. And it says Sitin's net assets were fair valued at 32 million. So I go to Sitin, and all I'm going to say here, it's got net assets of 32 million. On the 30th of November X9, we sold 60% of Sitin when its net assets were 36. And of the increase in net assets, we've got a 3 million increase in retained earnings and a 1 million increase in OCE. The sale proceeds were 23 million. So that goes into our disposal calculation. So I'm going to have a new working here, working number 9, disposal of Sitin. And this is actually part A of the answer. So here we've got our sale proceeds. What are those sale proceeds? They're 23 million. Let's remember the remainder of the formula. We've got the NCI at disposal. Well, the NCI at disposal is going to be 0 because it was a 100% owned subsidiary. We're going to add on to that the value of the remaining shares. And it says the sale proceeds were 23 million and the remaining equity instrument was fair valued at 13 million. So I'm going to put that in at 13 million. Grange could still exert significant influence. So can you see the value of the remaining shares is 13 million. I'm now going to have to go up to my associate and say it shouldn't be in at a value of 16, it should be in at a value of 13. The only entry made in Grange's financial statements was to increase cash and reduce the cost of the investment in Sitin. So that figure of 16 is fairly meaningless, so we should be putting it in at a value of 13. How else are we going to calculate our disposal of Sitin? We've got the proceeds, the NCI at disposal, less goodwill and less net assets at disposal. Now, what I'm going to do here, I'm going to break from normal strategy because we've actually got the information. At the acquisition date, the net assets are 32. We know that the cost was 39. So I'm going to say here, less net assets at acquisition are 32. Which means that our goodwill figure in respect of Sitin is 7 million. But I'm now going to transfer that goodwill calculation to our loss on disposal. And the net assets at disposal, so we pick up the goodwill from working number 3, the net assets at disposal come from working number 2. What are those net assets? In working number 2 it says, we've been told in the question that they're 36 million. So this is our loss on disposal of the subsidiary. It's 7 million. What am I going to do with that loss on disposal? I'm going to take that to my reserves note, loss on sale of Sitin. That's 7 million, and that's come from working number 9. So that's note 3 dealt with. We've only got another 5 notes to deal with. Note 4, Grange acquired land in an area where the land is expected to rise significantly in value. The land is currently held at cost of 6 million. Well, what I would say here, very few students did this at the time, the land qualifies as an investment property because it was bought because we're hoping that the value was going to go up. And it's held in PPE until Grange decides what it should do with it. The market value of the land at the 30th November X9 was 8 million. And this then fell by the 15th of December. But we're not interested in the post-balance sheet event because we're valuing it at the year end. So we revalue to fair value, and we take both gains and losses to the income statement. So I'm going to debit investment property 2 million. And I'm going to credit the income statement. Because it's an investment property, you take gains and losses on investment properties, not to OCE, but you take them to the income statement itself. So reserves 2 million, investment property, working number 10. And what I'm going to do in my statement of financial position is I'm going to take 7 out of PPE and I'm going to put 9 in to my investment property. Now, if you just added 2 to PPE, you wouldn't have been penalised in the exam. But strictly, we should be showing investment properties separately from other PPE assets. Note 5. Grange anticipates it's going to be fined for environmental pollution. Now, you wouldn't have to do full discussion in the exam, but I'm just going to just give this a little reminder. So here we're looking at the issue of pollution. We only create a provision if, firstly, we have a present obligation due to a past event. Now, the past event is the pollution that we've created. Secondly, there is a probable outflow of economic resource. And thirdly, a reliable estimate can be made. So those are the three criteria we're looking at. So the fine is an obligation due to the pollution we've created. We've also got to pay compensation of 6 million because that's in relation to the past event, which is the pollution. The regulator has requested that certain changes be made to the manufacturing process. There is no provision for the changes to manufacturing because no obligation exists. So therefore the provision, it's going to be the 1 million fine plus the 6 million compensation. So the provision works out at 7 million. Debit income statement, credit provision. Income statement flows through into group reserves. So provision, working number 11. I'm going to reduce retained earnings by 7 million and I'm going to increase provisions by 7 million from working number 11. So that's note 5. Note 6, we've got an overseas asset. So we're up to working number 12. And at the 30th of the 11th, X8, in terms of dinars, the asset cost 8 million. The rate was 2, so the dollar value was 4 million. At the 30th of the 11th, X9, we revalued it to 12 million. The exchange rate is 1.5, so the dollar value is 8 million. So therefore I'm going to debit PPE 8 minus 4, which is 4 million, It's a revaluation. We're not dealing with an investment property, so therefore the revaluation goes through OCI. So debit PPE, credit OCI, 4 million. That's from working number 12. So revaluation, working number 12. Increase OCE, because OCI flows through into OCE. And increase PPE from working number 12 by 4 million. Note 7. Note 7 is an absolute beast. I'm not saying the other ones are easy. So we're looking at a reorganisation. The board of directors has discussed the plan, but further work has to be carried out before they approve it. So the first thing I would say is no provision is required because no commitment exists. It does say, however, that Grange is concerned that the parent company's PPE have lost value during the period because of a decline in property prices. But however, an impairment review is needed due to the decrease in property prices. It says the directors have calculated the value in use as being 870 million if the reorganisation takes place. Well, we're not committed to the reorganisation, so we're going to ignore that 870 million and 830 if the reorganisation does not take place. So the net asset value per the SFP. What we have to do here, and this is where I think the question was really quite sneaky, we have to go back to our statement of financial position and find out the value of the net assets of the parent. Net assets is equity total. So can you see that our equity total for the parent on the face of the SFP is 862 million. But we've then gone through and we've made lots of adjustments. And this is where it really does get quite horrible. Think about the adjustments we've made to the property, to the parent. Well, we've increased the value of the net assets through the investment property of 2 million. But we've created a provision for the environmental damage of 7 million. We've got our currency gain stroke revaluation. Again, that relates to the parent. That is 4 million. We've got the loss on Sitin, which I should have put through. Sitin was in the accounts at 16, but remember we've said that its fair value is only 13, so that's a loss of 3. Oh, sorry, I meant to do that up here as well. I'll come back to that in just a sec. Remember, it was in the books at 16. We've said that the fair value of the associate's only 13, so I've got to reflect that decrease of 3. After we put through all of those adjustments, we've got a net assets total of 858, and we've said that the recoverable amount is 830. So our impairment works out as 28 million. I can assure you, when this question was set in December 2009, not a single student on the planet, not a single student in the galaxy managed to get that correct. It was a horrible, horrible adjustment. But we've worked out the impairment. It's 28 million. And I'm going to, they will relate to PPE or broadly relate to PPE. So credit PPE 28 million. And we're going to debit the income statement 28 million. For that particular one, it was only probably worth 2 or 3 marks, because when something's really, really complicated, we don't try to give it too many marks, because if we made it 7 marks, then people would be getting 0 out of 7 as opposed to 0 out of 3. So we've got our impairment working number 13 is 28 million. And 28 million up here. Note 8 is our ethical issue. So we've now dealt with all of the numbers as far as the question is concerned. What we can now do is we can go to working number 2, and working number 2 itself is quite a challenge. And we can work out our net assets totals. So for fence, net assets have increased from 206 to 210.5. For park, they were 370. And they are now 426. How much of that relates to OCE? Can you see? We've got increases in OCE of 4 and 9. So I'm going to say here plus 4 OCE, and the remainder is 52 increase in retained earnings. For fence, we've got an increase in OCE of 8. And oh, sorry, the contingent liability. I've got that. I've got the contingent liability bit wrong, I think. Let me just go back to that. I've just had a. It was already in the accounts at 30 million, so it should actually be an adjustment of a reduction in a liability is going to increase the net assets by 5. So I do apologise for that. Sometimes I've a And that's 240.5. Is it 232? Have I misread? Identify including any contingent liabilities. Well, the 202 comes from the question. And then, oh, I need to put through our fair value adjustment. 150 plus 73 plus 9. 232, yeah. So that figure of 30 represents the contingent liability. Sorry, I should have checked that. Which we've then increased by 5, like so. So 150 plus 65 plus 17 less 30 plus 5. So yeah, I was right at 210.5. I thought it was. So OCE has increased. Yep. Yep. So can you see that at the SFP date, the contingent liability was the figure of 30. If we've now got to say that the contingent liability is 25, I'm reducing the liability by 5, which is this figure here. Okay? So we've got an 8 increase in OCE. It's gone up by 4.5 overall. So therefore we've got a decrease in retained earnings of 3.5. Because we know we got to split up the increases and decreases in net assets between OCE and between retained earnings as well. We can now calculate goodwill. Our net assets at acquisition, 370 for Park, which means that goodwill is 30. And for Fence at acquisition, we are saying that net assets are 206. Remember, there is no NCI, so we've got a goodwill figure of 8. So goodwill in total adds up to 38. Remember, the goodwill in relation to Sitin disappears because we have sold Sitin. So we've got a goodwill total of 38, which I'm going to take to my group SFP. From working number 3. As far as the NCI is concerned, there is no NCI for Fence, so we don't have to worry about that. For Park, we're going to give them their share since acquisition. As far as Park is concerned, when did we buy the extra shares? Well, we bought the extra shares in Park on the 30th November X9, so that was the last day of the year. So the NCI have 40% of Park, and the profits of Park have increased by 56. The NCI don't care whether the gains go through OCE or retained earnings. So I'm going to give the NCI 40% of 56. That takes us up to a figure of 172.4. But we then have to take into consideration that Grange acquired a further 20% interest from the NCI on the 30th of November X9. So we're going to transfer to the parent. It's 172.4. The NCI did have 40%, but they now only have 20%. So can you see that we have sold, or the NCI have sold, 20/40ths of their investment. So that works out as 86.2, which gives the NCI a remaining balance of 86.2. What am I going to do with this figure? This figure is used to calculate our movement on the increase investment. So we have to separate these things out. So the first thing I'm going to do is I'm going to take the NCI figure of 86.2 and transfer that to the face of the SFP. We've got the increase in the investment in Park. We've credited cash 90. We've just debited the NCI with 86.2. So the balancing figure goes to reserves, and that's going to be a debit. And we take that debit through to OCE. So Park increase, that's from working number 7. So that's dealt with Park. We now have to deal with Fence. And what I'm going to say in respect of Fence, OCE has increased by 8. We own 100% of the subsidiary. So go to reserves. Fence increase post-acquisition is 8. And as far as retained earnings are concerned, the retained earnings have gone down by 3.5. So we show that as minus 3.5. We've also got to deal with Park post acquisition. And the group has 60% because the NCI had 40%. 60% of what? It's 4 for OCE and 52 for retained earnings. So 52 times 0.6 is 31.2 and 2.4. So that has dealt with the OCE. Have we finished with reserves? Let's check. We come to the associate. We would normally say share of post-acquisition, but the company became an associate on the last day of the year, so therefore there are no post-acquisition profits. So we've just got that figure of 13. So that's from working number 6. Let's go through the rest of the workings. Anything else outstanding? Well, we've got to deal with the disposal of fence. We did own 100% of fence, and we then sold some shares to the NCI. We disposed of 60% of the equity in Sitin. Oh, sorry, that's the wrong note. I picked up the wrong note. Sorry, we disposed 25% to the non-controlling interests for consideration of 80 million. The net assets at the date of disposal go up to working number 2. The date of disposal was the SFP date. Those net assets were worth 210.5. So I'm going to credit the NCI 25% of 210.5. Which is 52.6. So we're going to credit reserves with the difference of 27.4, and that goes through to OCE. Fence sale 27.4 from working number 8. Because it's an adjustment which goes directly through to equity. Right, yep, yep. So therefore we can work out our NCI, add on 52.6 as far as fence is concerned, and we've got 86.2. So up to here, NCI, that should be 86.2 plus 52.6. So that gives a grand total of 138.8. And I think we are now in a position to work out group reserves. Now there is no way in the world that this is going to balance. Even I admit defeat on this question. So OCE is 60. $394.7 for retained earnings. So let's just pop up OCE is 60 from working number 5, retained earnings 394.7 from working number 5, non-current liabilities 334, payables 354, so I've got 1763.5, but in the exam don't add it up. A, there's no marks given for totals. B, it's not going to add up, as I'm about to prove. I'm out by 3. I've added it up wrong somewhere. But that's